All right, this is going to get a little bit technical. Hopefully that's okay. There's just a lot going on, and a lot of people don't understand it, and I'm going to try to put it, I'm going to do it from a high level, believe it or not. Even when you see all the weeds we'll get into here, it's still high level. We just had this meeting, this Real Deal webinar less than a month ago. And a lot has happened, man. We've had 3 bank failures. We have had just, I think it was yesterday, signs of similar problems in Europe. Our Credit Suisse had to be propped up. Interest rate risk volatility has just considerably increased. And clearly there is a lot more uncertainty about what the Federal Reserve is going to do next week with interest rates when they meet. I mean, literally every day this week, if you have watched the treasuries, the interest rates, I mean, the volatility has just been off the charts. This wasn't happening when we met just a month ago. So I want to tell you what happened, but I want to give you a couple of banking basics so that you just understand. And I'm going to try to keep it up here, I promise. First of all, banks have to hold reserves in order to meet their cash needs, right? They can't lend out every penny that they have, because you might walk into the branch tomorrow and say, hey, I need my $1 million back. And they have to have cash to do that. So they have to hold reserves. They invest some of those reserves. They invest them in a lot of things. In this case, I'm just going to talk about U.S. Treasuries and mortgage-backed securities, right? Relatively safe investments that give them a return on the money that they have to keep on hand. Sometimes they may need some cash, more than what they actually have in their little vaults to meet depositors' withdrawals, right? And that's normally not a big deal because they just sell some securities and it really doesn't have much of an impact on their profits because rates generally don't move much. And so the value of those investments isn't going to change much. So normally it's really transparent. This goes on every day. None of us even knows it happens, but trust me, it does. Now, I'm going to get a little technical here, but I want you to understand how this thing works if you're interested. If not, just tune me out for the next minute or so. All right, I want to talk about how bonds work, because this is what actually got SVB and a couple other folks into some trouble. So imagine if the interest rates for a particular bond is 4%, and you want to buy a bond that basically is like that bond that pays 4% interest. So if you've got 100 grand to spend, you say, hey, you know what? I got 100 grand. I'm willing to accept 4% in exchange to own this security. So that's easy. You pay 100 grand for that bond. But now let's pretend like interest rates rose, right? Sound familiar? Interest rates did in fact rise. Well, what if it just went up from 4% to 5% on that type of bond? Now the world's a little different. And so now the people that would buy that bond, they're like, you know what? I'm not willing to accept 4% anymore. I want 5%. All right. Well, guess what? That $100,000 bond that's already out in the market, it already pays a 4% interest, right? It already pays $4,000 a year. They can't change that. That's set. But you have this person that wants 5%. So the only way for them to get 5% is if they pay less for that bond. So now that bond that's set in stone, that it's going to pay $4,000 a year, in order for them to get a 5% return, they have to pay less for the bond. In my example, this is an extreme example. This is not real. It's just meant to illustrate how bonds work. In order for somebody to get that 5% interest rate on that $100,000 bond, they're only going to be willing to pay $80,000 for that bond. So if they paid $80,000 for that bond, and that earned 4%, that gives them a 5% return, right? The person gets what they want. Here's the problem. That bond that originally was worth 100 grand is now worth only 80 because the market says, dude, I don't want 4% anymore. I want 5. Why do I want 5? Because I could go somewhere else and get just as much. So now you have a $20,000 loss, right? Now that's a bit extreme. I only did it this way because I want you to understand what happens to bonds. So let's talk about what happened in the banking world. So let's see, John, you're right. As interest rates go up, the price of the bonds go down. That's exactly right. So I did a little extreme example. There's a lot of other factors that go into valuing bonds. I just wanted to illustrate. Interest rate goes up, price goes down in order to make sure that everybody gets what they want. Remember in our last meeting, we talked about interest rates went from 0.08% to about 4.5% in about a year. That's like crazy increase. That's not a 1% increase. That's like 450% increase. The banks didn't protect, some banks didn't protect themselves properly. There's ways that they can hedge against interest rate risk. I'm not going to talk about all those things because it's way too much. But what happened was, if banks are only paying 2%, but you can go buy a U.S. Treasury that pays 5%, guess what you're going to do? You're going to pull your money out of the bank and you're going to go buy treasuries. Why? Because you want 5%. You don't want 1% or 2% or whatever the bank was offering. So what happens is people start withdrawing their money out of the bank. But here's what happened. They pulled out so much money out of this one bank that the bank ran out of cash. They literally ran out of cash because they all went in and they said, look, we're talking about billions of dollars all at one time. In fact, in one day, they withdrew $42 billion out of one bank for lots of reasons. So the bank ran out of cash. They tried to raise equity. They couldn't. So what did they have to do? They had to sell these securities. When they sold these securities, those securities weren't worth what they were when they bought them. So they had to recognize a huge loss. In the case of SBB, I think they lost just under $2 billion on that security sale. Well, when the people that had deposits in that bank said, oh my God, this bank just took a $2 billion loss, it needed cash, they all got nervous, and literally it was an old-fashioned bank run. Although it was just done on their phones and their computers. They pulled out $40 billion in one day. Bank ran out of money. There was nothing they could do about it. And the FDIC came in and took over. And literally within 48 hours, a bank died. Then the next day, another bank. Same thing happened. The FDIC had to take that bank over as well. Does that make sense to everybody? Are we cool with that? All right. I know I'm oversimplifying the problem, but I want you to understand what happened. So now, why are rates so volatile? Well, after our last Real Deal webinar, when I told you things were calming down, there was a lot more stability. It was great. I really enjoyed that because now we could do deals. Literally, I think we got out the webinar and rates just exploded. What happened was we got a couple pieces of inflation data that said, uh-oh, inflation is not going down as much as they thought. The market really believed now that the Fed wasn't going to raise just a quarter point. They were going to raise 50 basis points or maybe even more. So the market overreacted like it usually does. And so now rates went up, right? Chairman Powell, before all these banking problems, we even went before Congress and said, you know what? Inflation seems to be kind of stickier than we thought. We might have to raise rates more than what we thought. So now rates went up. And I'm talking about 80 basis points, almost a full percent in a couple of weeks. I mean, it's ridiculous how fast it moved. Those increased rates caused the banking system to kind of break. There were other factors that were involved. There's no question about that. There were other factors that are involved. Is that better? Sorry about the audio, Maurice. The banking system broke in part because rates went up and they went up very quickly. Now, yeah, was it management's fault in some of these banks? Yes, but in part, none of this would have happened if we didn't have this massive rate increase, for sure. So now, because of all these bank failures, many people believe the Fed may not raise rates as much. You can see, I mean, literally, this is a knee-jerk reaction almost daily that's going on. And what we're seeing now is the interest rate world is responding to every little piece of data it gets, because the market views every little piece of data it gets in the extreme. It's just the way, it's just the place that we're in right now. So what matters? What's next? Look, opinions are all over the map. Nobody knows. In fact, in the last call, I brought you some information from ITR Economics, a firm that we follow. I didn't even bother to do that. The reason I didn't do that is because there's so much going on. I don't think any of their projections can really help them. So nobody knows what's next. There's just opinions are all over the market, all over the map. There's no question that it seems like there's a pretty good chance markets will be volatile for a while. And I say markets, I mean interest rate markets. The Fed is now faced with kind of a dilemma. They either stay laser focused on inflation and no matter what, stay on their mission of beating down inflation, or they focus on stabilizing the financial system and take a break on these interest rates. Yep, DJ, I'm with you 100%. So now we'll see. Next week is another Fed meeting. I mean, you can make arguments both ways. We don't know. The Fed is definitely in a precarious position. because nobody wants to break the banking system. That is certainly not a good idea. But they also don't like inflation. So we'll see. I have nobody has a clue where they're going to fall, where they're going to shake out. I don't even think they know at this point. So all of these things, all this volatility, all this stress and fear is definitely going to impact decision-making by banks, companies, consumers, everybody. Don't be surprised if you don't see people going into defense mode, right? So consumers will slow down their spending. Companies might start to hoard a little more cash than they did otherwise. What does that do? That slows down the economy, right? Kind of helping the Feds, if you think about it, because that's what they've been trying to do. And if you like the content that we've shared here, please be sure to subscribe to our channel and hit the bell. So thank you again and have a wonderful day.